The Swiss franc has a reputation that most currencies never earn. When the world gets nervous, geopolitical tensions, financial shocks, economic instability, investors move money into the franc. That one characteristic shapes almost everything about how the USCF pair behaves. USD CHF, known in trading circles as the Swissy, measures how many Swiss francs it takes to buy $1. If the pair is trading at 0.980, $1 costs 90 centimes. Simple enough. But the dynamics underneath that number are worth understanding before you trade it. Switzerland's safe haven status comes from a specific set of conditions: political neutrality, a stable and independent central bank, strong financial institutions, and low public debt. These aren't marketing points. They're the reasons global investors treat the franc as a store of value during crises. When fear rises, demand for the franc rises with it, and USDF tends to fall. When markets calm and risk appetite returns, the franc often weakens, and the pair moves higher. The Swiss National Bank, the SNB, adds another layer. The SNB has a history of intervening in currency markets to stop the franc from appreciating too sharply. A strong franc hurts Swiss exports. When the SNB signals intervention or adjusts its policy, the pair can move fast and hard. SNB announcements deserve the same attention you give to a Federal Reserve decision. Speaking of the Fed, monetary policy from both central banks is the core fundamental driver of this pair. When the Fed raises rates or signals tighter policy, the dollar typically strengthens and USDF moves up. When the SNB acts, the franc responds. Beyond central bank policy, watch U.S. non-farm payrolls, CPI inflation data, and GDP figures. From the Swiss side, inflation reports and trade balance data matter. There's one more feature of this pair that traders should know about. USD CHF has a historically strong inverse correlation with EUR USD. When EUR USD rises, USDHF tends to fall. The Swiss and Eurozone economies are closely linked, so the currencies often move in the same direction against the dollar. This correlation isn't perfect, but it's consistent enough to use as a reference. If you're trading both pairs at the same time, you may be doubling your exposure without realizing it. As for strategies, trend following, range trading, and news-based trading all get applied to this pair. News trading around SNB announcements and US data releases can create opportunities, but it also creates volatility and wide spreads. That's real risk. Trading involves real money and real losses. Only trade what you can afford to lose. One practical habit that pays off with this pair: check the economic calendar for both the US and Switzerland before each session. Knowing when major data drops are scheduled means volatility won't catch you off guard.